Don't forget to subscribe, like, and hit the notification bell. Okay, everybody, it's Kevin Wadsworth from NorthStarBadCharts.com, and I want to talk you through some technical analysis charts and evidence that leads me to ask the question, what if everybody is wrong about interest rates and about where we're heading? Now, of course, the markets are looking for rate cuts and a resumption of a rate cut cycle after the recent rate hikes, of course. And I took a position a number of years ago which was controversial at the time, and the 10-year yield was breaking down and was at a very low level. Now, I said at the time that I expected the 10-year yield was most likely to move up towards the 5% area from its levels close to zero at the time, between 0 and 1%. Now, that went down a little bit like a lead balloon, and a lot of consternation at the time. But the technical chart made it very clear that that was the most likely outcome. And then I posed a question along the lines of, well, a statement along the lines of the fact that that would cause a huge amount of pain. We would be crossing a threshold that would put us in a new paradigm entirely. And that shift was a multi-decade change. Now, this all ties in with what I'm about to show you and has far-reaching and very fundamental, very dramatic consequences and implications. Okay, so I'm going to go straight to the charts now and talk my way through this. Bear with me because I'm not an economist, so feel free to put me right on any particular points around economic matters and any comments that I make around the economic side of things that you think don't sound quite right. But my expertise and my knowledge lies in technical chart analysis, gathering the weight of evidence scientifically from what the charts are telling us. I've already explained in the last couple of days that the charts represent the fundamentals. So if you're thinking about all of this from a fundamental point of view, bear in mind that the charts are the fundamentals. They're one and the same thing. The chart is the physical representation of everything that the market knows about the fundamentals. So if something fundamentally changes, if there's a fundamental shift, then when it affects the price chart, then that's when that fundamental input is moving reality, and we can react to those movements through the technical chart analysis itself. So fundamentals and technical chart analysis are really the same thing. It's just that the technical chart analysis makes it a lot easier for us to interpret what the fundamentals are trying to say. Of course, the fundamentals are made up of a lot of stuff that we think we know, a lot of stuff that we know that actually turns out not to be true, and also it's made up of stuff that people far more knowledgeable know, and big market movers, market players know that we don't know. So that's why, or one of the reasons why the price chart is so incredibly useful. I'm going to share my screen now and talk through what I think is a pretty dramatic set of circumstances and has such far-reaching consequences. So I'm going to switch my screen sharing on, and I'm going to turn my video camera off just so that you're not constantly distracted by my little image in the corner of the screen there. Okay, so that's the screen sharing switched on. And I'm going to start with a tweet that I put out back in 2019. You can see this here. And this was forecasting what was likely to happen with the price of gold. So here's the tweet itself. This is the chart. And what I said in 2019 was that gold, bear in mind that gold is a barometer in many ways of what is happening in the economy. Gold simply sits there and measures your loss of purchasing power. Okay, gold doesn't go up. It's the dollar or the currency that's going down. Okay, and over time, when I say over time, I mean over multiple decades, gold tracks loss of purchasing power just like everything else does. Everything else does to varying degrees at various points in time. Now, my prediction using the technical chart analysis was that price at that time around $1,500 would suffer a little bit of a pullback and then form some kind of a pattern to break out and move up to $2,000 by 2021, and then form a multi-year pullback, a handle to this cup with a breakout at some point after that. We all know, of course, that that is indeed what happened. The chart itself, let me just go back. The chart itself, as it developed, looked like this. So there's the prediction that I made in 2019, and this is what the chart did next. So all the black arrows are transposed from the prediction to the chart as it developed. So you can see how the price followed very closely my predicted path. It broke out of this handle when the hostilities started from between Russia and Ukraine, and Russia crossed the border to invade the eastern part of Ukraine. So at that point, the pattern broke out and retouched those all-time highs. We know what happened since then, of course, and that's been included in my forecasts. Another look at the forecast that I made in 2019 using some cycle analysis, and all of this analysis is done with weight of evidence. There are multiple techniques. This one happens to show the gold cycle, and it again shows this basing pattern. At the time, $1,326. My forecast was for that move up to the 1500 area, which we saw in the previous chart actually did happen, and then for a pullback, and then for an accelerated move up to the 1900, 2000 area, and then a multi-year handle consolidation pattern of going nowhere. And then on this particular chart, I'm showing it breaking out sometime in 2024 towards 2025. And again, we know what happened. That is precisely what has happened. So the forecast made back in 2019 followed my expectations through 2020, 2021, 22, 23, and 2024. So I'm not showing this, I'm not putting this here just to kind of show off. I'm here to try and get it into your mind that technical analysis, when it's done, in my view, correctly, with weight of evidence, not just looking at one or two particular indicators, with weight of evidence, you can show what is most likely to happen. Now, this path that I predicted wasn't me saying this is what's going to happen. It's me saying this is what is most likely to happen. It's the most likely path for the price of gold in US dollars. And price did continue to follow the most likely trajectory. And at each point in time, I reassessed how likely gold was to do whatever, to go up or to go down. So I've been constantly on social media, on Twitter, been updating this forecast, and I'm doing that to this very day now. So all the way along, I've updated this, and of course our website members get a lot more detail with forecasts of where I think this is going and when. Okay, so moving on to something here that I want you to get into your mind, which is houses priced in gold. And please don't worry about this logo in the bottom right hand corner. Yes, Kinesis are great, and they advocate gold and silver, and you can also buy cryptocurrencies and Bitcoin through Kinesis, and there are plenty of other similar organizations that do similar things increasingly because of what is happening in the global economy at the moment. I don't want you to worry about that or think it leads to any kind of bias, because I can promise you it doesn't. If I thought gold was going to go down and the technical chart said gold was going to go down, I would say so. And in fact, I have said so in the past, because when we hit that 2000 level, of course, the expectation was for a downward move in gold. So throughout this correct forecast, I have illustrated points in time where I think the odds favor some kind of pullback, consolidation, or pause in the gold price. But put very simply, gold over time trucks your loss of purchasing power. This is houses priced in gold. So if you'd bought your house in 1975, it would have cost you 238 ounces of gold. And if you're buying it now, it costs you 238 ounces of gold. So house prices haven't gone up if you use real money. Gold is real money because it doesn't inflate away. It doesn't. You can't print gold. You can't magic gold out of thin air for thousands of years. It's just done what gold does. And to be frank, it's done what houses do, and it's done what let me say a diamond does, or a fine work of art, or anything else that people will invest in, anything solid that has worth and value. Even things like a meal in a restaurant or a can of beans. Okay, so it's not going to last for 50 years and it's not going to still be worth the same in 50 years' time. But what I'm saying is that the price that you have to pay for that can of beans, that meal in a restaurant, has moved up in US dollars. So it has maintained its value. That meal, if you could have frozen it in time and brought it through to now, in a way, it has maintained its purchasing power. All I'm trying to say is that everything around you that you see going up in price, in it, sort of in inverted commas, it's not going up in price. It's your dollar that is going down, or your pound, or your euro, or whatever. So, with real money, your house prices. There are times when houses outperform gold, and there are times when gold outperforms houses. But taken as a whole, throughout that 50-year period, gold has protected your loss of purchasing power. And it goes back to that saying that in Roman times you could buy a fine suit, a fine set of men's clothes or whatever with an ounce of gold. And today you can do the same thing. Very broad, general sweeping statement, and someone's probably going to put something in the comments to show me that isn't quite right. But in broad terms, that is a truism. It's pretty much a fact that an ounce of gold will buy what an ounce of gold buys at any point in history, and it tends to only fluctuate by a relatively small degree compared to the US dollar. Now, what have we got here? We've got the United States average house prices, and we've got the price of gold. So this is just to illustrate that over the period from 1975, both have risen, and both have risen, broadly speaking, a similar amount. If you move the starting point along, you get slightly different pictures. So if I move it along to, let's say, 2000 or the early 2000s there, what you can see is that gold has strongly outperformed houses, because gold has gone up 764%, and your house price index has risen 260%. So gold has has outperformed houses by more than double so far this century, broadly speaking. But if you take it all the way back to the starting point in the mid 1970s, post Bretton Woods, and the dismantlement of the gold standard, then what you can say in broad terms is that houses and gold are accelerating upwards at a roughly similar rate, although there are points in time where they diverge, but over time they're moving at a similar rate. And that's just because both are reflecting your loss of purchasing power, as I said. Okay, so this is a chart showing that loss of purchasing power, and from the sort of 1970s there to where we are now, something like I think it's something like an 80%, 70 to 80% loss of purchasing power, of course, all the way from the early 1900s. It's something more like 95, 96, or 98%. I lose track of just what the exact percentage is, but it's way, way above 90%, and I think over 95%. So this illustrates that it's the dollar decaying that gives you the illusion of prices going up. Okay. So all that said, we've got here gold versus inflation. Now, what I want to illustrate is, does gold beat inflation? We've got gold versus the CPI here, and since around about 1970 or so, gold has outperformed inflation by about 400%. But if you take the peak at 1980 and then the peak in 2011 to where we are now, roughly speaking, gold has gone sideways. So if you look at the headline grabbing clickbait peaks and spikes in the price, then each spike in terms of inflation is at a similar level. But what you need to actually look at is the trend. And in order to view the trend, I've put on the 10-year mean. So the green line there is the average 10-year price. So at any point on that green line, it's showing you what the price of gold has averaged over the previous 10 years. And as things stand at the moment, we are at all-time highs for the 10-year moving average for the price of gold. So the trend from the 1970s to where we are now is clearly up, but the trend even from 1989 at the previous peak to where we are now is up. Okay, so gold is outperforming consumer prices. Okay, so the next chart is the Swiss franc versus the US dollar. The Swiss franc strongly correlated with gold, of course, and you can see that the period from let's say 2001 to 2011 was characterized by the Swiss franc breaking out versus the US dollar and rising to a blow-off peak, and then entering a downtrend, a bear market, which then stabilized and has been pretty stable for a good number of years before the recent sort of moves to the upside. Looking at the 7-year rate of change indicator at the bottom, it illustrates for you the underlying momentum. And as we were breaking out back in the start of the previous gold bull market, the black line broke above the green line there. So the rate of change broke above its 3-year moving average and entered a bull market. And look at what's happening now. The 3-year rate of change is above the green line. It's above the 0 line. It's indicating that we're in a bull market for the Swiss franc versus the US dollar. So it's telling us that the US dollar is likely, nothing certain, but it's likely to underperform the Swiss franc over the coming years, which puts gold in a bull market in all probability. Okay, so moving on from that chart, and we're just going to touch on stock markets here for a moment, NASDAQ versus inflation. And there's reasons to be somewhat cautious with stock markets, same with the S&P and others, because although we're at nominal highs, and in fact, yeah, well, we are actually now at nominal highs in the stock markets. What we're seeing is that this breakdown below a decade-long support line, this breakdown is now being back tested. Okay, so what I can say here is that as long as we stay above these two black lines, horizontal black lines, then it's safe to be pretty bullish on the NASDAQ. But the moment this pulls back and moves below, what number is that on the chart? 68. No, it's not 68.91. What is it? Let me just zoom right in for you. 66.62. So 66, 67, that kind of area. If this ratio pulls back below that, then we have a problem, and it would be indicating to me that the NASDAQ is in a bear market, or is entering I'm trying to find the right words to put this. I mean, because we're at all-time highs at the moment, we're clearly not in a bear market, but we are at risk of rolling over into a more significant bear market if and when the chart falls below this particular spot here. Okay, and this is what the technical analysis is highlighting for us. If we break below that red circle, then we've got problems. If we break above this red upper black line, then it's some kind of melt up mode. And should that happen, make that solid black line, should that happen, my primary expectation, and this isn't because I'm a perma bull, but because of the particular chart pattern that we have, my primary expectation would be for some kind of crazy melt up, followed by what's called an around the apex move to the downside. And those tend to be very violent and aggressive to the downside. So that would be my primary expectation if we do break to the upside. Okay, so there's a lot to keep an eye on with the stock markets at the moment. And it's more, as we push higher, it's more a case of being appropriate to exit your long positions than to start taking short positions. The short positions should really only be taken when we cross back below these levels that I've indicated. Okay, so more importantly, and moving on to the 10-year yield. Now, this is a chart that I put out back in 2020, actually, but this is the 2021 update. And I want you to look at this carefully, because the 10-year yield was in a 40-year bullish, descending, expanding wedge pattern. Okay, now that all sounds like hocus pocus mumbo jumbo, but what it basically means is that the entire trend was contained by a resistance line and a support line, which broke to the downside in 2020 there, as a lot of charts did. And that is, historically looking back, for historians and economists, going to be an incredibly important, or already is an incredibly important point, because it marked the end of one era and the beginning of another. So the era of constantly decreasing 10-year yields that came after the interest rate mayhem in the 1970s, when interest rates peaked somewhere around 16% or nearly 16% on the 10-year yield. The interest rate on 10-year dated government debt has been falling, and it came all the way down to close to zero there, I think, at one point. And then because it was a false breakdown, or it was a breakdown from a bearish, sorry, I get my words right, it was a breakdown from a bullish pattern, I was able to say at that point that the odds strongly favored a violent upside reversal and a move up towards the 5% area through resistance zone 1, resistance zone 2, and up to a target area which I identified on the breakout of 5%. Now, at the time, there's a lot of reluctance to sort of accept that and believe it, if you like. But of course, we know that that's what happened. And then later on, I produced this post as the chart confirmed the breakout and the move into a completely new environment. We broke through what I was calling the pain line, this upper resistance line. The numbers in the boxes there, by the way, that's debt to GDP. So debt to GDP is rising as the yield was falling. And I would, again, I'm not an economist, but I would say that the reason the yield was falling was because the debt to GDP was rising. In order to service that debt, you want to have decreasing interest rates to pay that debt. Otherwise, your debt servicing bill suddenly becomes unmanageable without printing even more debt, which of course is what we do. Now, talking about the yield chart, and another important yield chart here is the 10-year minus the 2-year yield. It represents the yield curve inversion. The 10-year yield, of course, is usually higher than the 2-year yield, with forward expectations of inflation tending to be higher than short term. So the yield on longer term debt is higher than shorter term debt, and the number that results in a positive number. So usually the graph is above zero, as you can see. There are times when the graph dips below zero, and when it does that, it's called a yield curve inversion. Now, each time that happens, and then the curve uninverts and the graph goes back up above that red zero line, we get some kind of crisis, and you can see the crises labeled here each time it happened. So you can see where we are now, and a crisis lies in the future. It could be in a few months' time, it could be in a year or two's time. We just don't know. But once we start to uninvert, then we know we've got problems coming. As a result, at the moment, the likelihood of a high impact event remains low, but it will be a high impact event. So we're in this right-hand column here with our warning. When the yield curve inversion gets closer to that red line and interacts with the red line, then we're going to be into a high likelihood of a high impact event. And this marker, this check mark, will move up to the appropriate box in the warning matrix. So that's where we are at the moment. So what if everybody's wrong? What if this 10-year yield chart is telling us that, yes, we're in a new paradigm now. We have had 40 years of declining 10-year yields, declining interest rates on debt, and we've now broken out. This is a 40-year bullish descending pattern. And what happened the last time we broke out of a multi-decade pattern and through the pain line? We experienced a whole world of pain. That happened in the mid to late 1950s and led to 2 or more decades of rising 10-year yields. But the difference then was that debt to GDP fell from 70% in the sort of post-war years to 31%. So debt to GDP was falling, which I suppose made it somewhat less problematic to raise interest rates from 1.5% to over 16%. But we're in a very different world now. Debt to GDP has risen from that 31% to, I think it's over 130 now. I've labeled it 129 because I did this chart a while back, but I'm pretty sure debt to GDP is north of 130% at the moment. And Fed fund rates fell from 16% to 0%, I would suggest, in order to manage that growing debt burden. But with an inflationary environment, inflationary pressures, the 10-year yield and interest rates have had to start edging upwards, of course. And we found ourselves post-COVID and with a whole load of global conflicts going on, for a lot of fundamental reasons, why input costs and consumer costs are likely to remain elevated. I'm not going to say they're going to run away into some kind of hyperinflationary event. They may do eventually, but at least accept the fact that there will continue to be pressure on consumer prices. And I don't know about anywhere else in the world, but here in the UK, consumer prices went up a huge amount over the last 3 or 4 years. And with inflation now back down to somewhere around about 4% in the UK, that's the official figure. I suspect the real figure is perhaps double that, but anyway, we'll talk about the official figure at 4%. It means that none of those prices are coming back down again. And so even if inflation came down to 0%, none of those prices are coming back down again. Those price increases are locked in all around us. And the next wave of inflation, when it comes, for whatever reason, is going to continue to put increasing pressure on the Fed to at least not reduce rates by very much, and quite possibly to increase rates. So this whole narrative around moving into a rate cutting cycle, it may be somewhat overstated. Yes, I mean, I've acknowledged that rates could come down to, or yield, I should say, could come down to 3%, could even potentially come down to 2%, 2 or 3%, and backtest this pain line. But as long as we remain on the wrong side of the pain line, the next move is, in all probability, it's either going to be something like this, or it's going to be something like this. So it may take, as you can see, many, many years for this to play out. In actual fact, I doubt it's going to come all the way back down at that sort of angle and retest the breakout line. It is a possibility, but I think more likely there's a little bit more consolidation here, perhaps for another year or so before a renewed upside surge there. Maybe not to that kind of level, but perhaps up to here, and then another little pullback, another move up. So yes, there's some scope for falling yields, falling interest rates, but I suspect not for long. I know this goes against the narrative that's out there, but looking at the chart and comparing to the 1950s and 60s, I just wonder if that's the sort of situation that we are in. Now, here's another chart showing US government debt to GDP. That's the green line. And we've got total debt on the red line there. So total debt is accelerating away, obviously a very rapid fashion. We're now at something like 34 trillion, even though the marker on the right-hand side here says 31 trillion. It's actually around about 34. This is an annual chart. It's updated every 12 months. Debt to GDP, as I say, I think is north of 130% now, so that may be slightly out of date. But looking at that 10-year yield chart, we broke out, back tested, and we're actually up to here now, around about what was it, 4%? I think we're sitting at the moment, near enough. And the last time we were there, debt to GDP was 40%. You can see if we track back from this bar chart where we're at it now, 4%. If we track back to where the relevant point over here on the left-hand side of the chart, that's around about 1967, early 1967 or 1968, the following year as well. And debt to GDP was around 40% at that time. That's the green line. Well, debt to GDP now is north of 130. So we've got the same interest rates and yields, but the debt to GDP is very, very different. So we've got a problem, I think. Going back to gold and how gold is reacting to all of that, this is a very long-term gold chart combining cycle analysis with one of the indicators, the moving average convergence divergence indicator, which gives a very, very good signal each time we break out and have a bullish move to the upside. Very big breakout, of course, in 2001 there. So we're awaiting each of these red lines, by the way, vertical red lines, is a cyclical low. The cyclical lows occur every 7 to 8.5 years, all the way back to the sort of early 1970s there, or the mid 1970s, I should say. So there's repeatable pattern after pattern after pattern after pattern where we get these cyclical lows. And we could very well be witnessing the new breakout here. The MACD indicator is looking very bullish. And I would say once we get to $2,100 on a monthly closing basis, it kind of seals the deal, really. And that would be a confirmed breakout. And it would be a very large pattern breakout as well, with a similar sort of significance to 2001. I'll be expecting a very big upside move. And partly because this resistance line is also in play just there. So we'll be breaking out of a pattern that actually goes all the way back to 2001. So it's a multi breakout pattern which encompasses more than one cycle. So I would expect a huge move to the upside, probably initially of $700 or $800 over less than a year, and then a pause, and then further upside moves beyond that. But gold is kind of doing what I said right at the start there, and it's kind of measuring all of this stress. And gold doesn't need falling interest rates, by the way, of course, because look at what gold's biggest bull market ever in the 1970s occurred during that period when the 10-year yield was rising all the way up to 16%. So gold has its best performances during environments of rapidly rising interest rates and yields, highly inflationary environments. Where inflation has been more muted over the last 40 years, the performance of gold really has been also pretty muted. Yes, we've had a big bull market from 2001 to 2011, but that was on the back of going nowhere for something like 20 years. Okay, so gold has plenty of reasons to be wanting to move to the upside at this point in time. I think global monetary policy's got a lot to answer for. And just in case we need reminding, it's not just a phenomenon in the United States. Gold in euros is at all-time highs and has broken out. Gold in Australia is at all-time highs and has broken out. Gold in British pounds has broken out, back tested, and is at all-time highs. Gold in Canada has broken out and it's at all-time highs. Gold in China has broken out and it's at all-time highs. Gold in India has broken out and it's at all-time highs. Gold in Japan has broken out and is at all-time highs. Gold in South Africa has broken out. Major pattern. It's all-time highs. Gold in Turkish lira, well, really, it's an illustration of what happens when a currency fails. It's up 13,000% in 22 years. It's up 1,300% in 7 years. And it just continually breaks out and moves to all-time highs. Gold in the world currency unit, bringing together multiple global currencies, has broken out and it's at all-time highs. So precious metals are, despite the caution and despite the fear that seems to be around at the moment surrounding precious metals, they have all performed textbook breakouts and are sitting at all-time highs. Now, that may or may not indicate that a huge bull market is developing. If there are signs that this is breaking down and something bad is happening, then that will be something that I will report back, particularly to our website members first, of course. But this does not look bearish for gold at the moment on that basis. Looking at the producer price index, just interesting to note that it took in the 1970s 22 months and 28 months during its most rapid rises to add 35% to the producer prices. We've just recently added 35% to producer prices in 8 months. And that this is a log chart, of course. It's a logarithmic scale on the right-hand side. So it might look as though it moved much further here in the 1970s, but it's because it's a log scale. If you look at the numbers, we moved from 206 to something like 279 there. It was anyway, it's a 35% move in 8 months. Actually, I beg your pardon, it's not 8 months, is it? It's 16. Just noticed a slight error there. There we go. In 16 months. Important to get that right. And I'll just double check that. Yes, yeah, so 16 months. So it has moved up 35% much more quickly than it did do in the 1970s. The US house price index has moved up since 2020 by nearly 50%. Nearly 50%. So that's just illustrating the loss of purchasing power of the US dollar in just 4 years. 50% increase in house prices measured in the US dollar. Okay, and moving on to gold again. And gold is in a very big consolidation pattern. As I said, this upper breakout line is very, very important. If we break out above that on a clear closing basis, then this thing is incredibly bullish. And as I say, is indicating that gold is likely to go much, much higher. So I'm just going to finish with a commodity price chart. This is the CRB index, and just looking at upwards pressure on inflationary upward pressures. This is just one element. Of course, things like energy and everything else need to be factored in, oil and all the rest of it. But the CRB index, the commodity index, broke out from a 2-decade bullish descending pattern back in 2021. Same sort of breakout that we saw on the 10-year yield, a false breakdown, rapid upside reversal, and now we've got the same sort of consolidation going on that we saw with the 10-year yield. Now, if this pattern holds, and if we resume the upside movement and cross through that solid black line, then it's all systems go for another upside surge. Of course, if the pattern breaks to the downside, it could come all the way back down to this solid red line, which is a support line somewhere down near 201. So we could see a drop of about 25% if it was to come all the way back down there to test that support line. Seems unlikely. It's possible, seems unlikely, but charts like this are going to give us the heads up as to whether my theory is right and whether my idea is that inflationary pressures are going to end up limiting the Fed's ability to cut interest rates meaningfully for any period of time. I do feel that we're in an environment where interest rates and where yields are going to struggle to be brought down by the Fed for any significant period of time. And that 10-year yield chart is at the heart of it all. It's right at the heart of what's going on, and it's that is behind that and the yield curve inversion, and what the gold chart is telling us, and all these other multiple pieces of evidence. It's those that are behind what is going to happen next. And as I said, my most likely scenario, my expectation is for a lot of pain to be developing in the global economy. Could be the banking sector, finance. I'm not sure exactly where this is going to break, where the stresses are going to show the most, and where the stress is going to show first. But we'll probably start to see more cracks appearing over the next few months. So stay tuned for that. Keep listening. Keep watching my charts. I'll let you know on social media here what's happening with the general trends, and of course, website members will get specific actionable trade information as well to act upon. Okay, that's it from me. I hope you enjoyed that. I hope it wasn't too depressing for you, but there does appear to be, as I say, a whole world of problems lying ahead in the not too distant future. That's it from me for now, and speak to you all again very soon. Bye-bye.